to the Business Lending Podcast, brought to you by Business Lending Brokers, your lender, your small and medium-sized company lender for all your needs. Okay, today we're going to talk about how to choose the right funding option for your business. But specifically, we're going to do a huge analysis of a product called line of credit. Line of credit, as you know, if you're business people, it's is one of the many options that perhaps any business can access to as far as lending is concerned. We have done in the past, in the previous podcast, we explained the difference between traditional and non-traditional lending. And obviously, we talked about the benefits of having a non-traditional lender versus having a traditional lender, which is the more important thing is time. It's time because when we need funding, when we have an emergency, a cash emergency, and that happens in every business. When we have a cash emergency, we need something to be resolved quickly, and perhaps even that the traditional lenders will like to help. Normally, they're very slow as far as approval, underwriting, and funding, while the non-traditional lending, it's more kind of efficient in giving you an approval, which takes about a couple of days, and funding afterwards, which takes another 3 or 4 days. So kind of in a week or so, you're up and running with the necessary cash that you need for your business. So today, we're going to talk about, specifically lines of credit. We're going to do an overview of line of credit. We're going to do how to manage the line of credit, how to apply for a line of credit, and the factors that you need to consider when you apply for a line of credit. And obviously, the most important thing is different types of lines of credit. Line of credit, it's obviously just a big word, but that has variations as far as the many applications of the line of credit can be used as far as your business is concerned. Now, as you know, we are live in Facebook, we are live in LinkedIn, it's going to be published in YouTube. This is a weekly podcast. We do one podcast in Spanish, one podcast in English, or vice versa, where we explain perhaps in each language the benefits of getting funding for your small and medium-sized company. This is being done every Monday from 2 to 3. And again, I apologize for being here a little late. That tells you that sometimes we're running through technical issues, and I apologize for that. Well, let's jump into lines of credits, okay? Let's do an overview of what is a line of credit. Well, line of credit is a preset borrowing limit that can be used at any time. In other words, a lender will give you $100,000 as a line of credit, which is preset. We know what's the limit. The limit is, in this case, I'm giving you an example. The limit in this case is $100,000. So that is the preset borrowing definition of the line of credit. The other part is it can be used at any time. Obviously, you don't need to use $100,000 at once. As you go, as your business goes, you may need $20,000 for marketing. You may need another $20,000 for payroll. You may need another $50,000 for inventory or for equipment. Obviously, we cannot go above the preset borrowing. We need to go, in this case, in this example, up to $100,000. Now, one of the key features in the credit, in the line of credit, okay, you take one of the things that are very important, how to control your borrowing, is you take what you need, basically. So you're in control of your debt. The bank can tell you, based on your income, based on your experience, based on the kind of business that you guys have, your business qualify for, again, we're going back to $100,000. So you control, as a business owner, you control what you need. you control your debt, you control your payments. So again, you don't need to take all the money at once unless you need the money at once. But if it is because you are behind some payments, or you got to pay an IRS lien tax or an IRS payments, and you need some cash right away, you control your debt, and based on what you're taking out, and then you may be making interest payments, so you control your interest payment as well. So the difference between a line of credit and the traditional loans that the bank will give you is that you're not required to pay everything at once. You make the monthly payments based on the money that was taken out. So I don't want to be redundant, but if based on your cash flow and based on the money that you need, then the payments get adjusted based on the balance used, not the full amount of the line of credit. Now, why are we taking lines of credit on for our business? Well, it's a way to manage your cash flow, especially for people in businesses that they have seasonal income. Some businesses are specifically, they're doing great in the summer and not in the winter, or vice versa. Some businesses are really doing very well in the winter, but in the summer is a slow month. Or some businesses have unexpected expenses, or you have to perhaps buy some inventory which the wholesaler sells you at a discount price, and you got only a week to pull the trigger on that purchase, and you need the cash right now. Obviously, if you go to a traditional bank, by the time you do the application, it gets underwritten against. They give you the sets of conditions that you need to meet, whatever paperwork you need to submit, and then they need to go back to underwriters for getting approval. And then if they get an approval, you need to wait until they get funded. By that time, the offer from the wholesaler, it disappears because it's more than a week. So when you need to pull the trigger, you need to make sure that you're working with a bank that will pull the trigger with you in your time. And again, also one of the benefits, if you will, and we talked about that earlier, is you borrow what you need. And again, when you pay them off, it goes back to, in this case, $100,000. Once you pay them off, you still have $100,000 to use. Now, what you need to watch is obviously the term of this loan. Excuse me, the term of this loan. And if you give you a line of credit for 3 years, then you know that you can actually use the money as you wish, pay it back, reuse it again, but you got 3 years to do that. Perhaps when the 3 years are done, then obviously you need to pay whatever is owed to the bank in full and reapply for a new credit line for another 3 years, and maybe they give you more money. But again, in those 3 years, you take $100,000 as many times as you need, as long as you pay it back, and that's what is called revolving. It's like a credit card, for instance. That you have a $10,000 limit. You go to the store, you buy stuff, then you pay, and then you still have whatever you use, you pay it back, and you have an available balance. Now, talking about credit cards, you can use your credit card also to buy stuff, perhaps get a cash advance on your credit cards. With some credit cards are very limit of what they can give you as far as advance and how much money and how many times. But also the interest rate that the credit cards are charging are outrageous compared to the business line of credit. So it's one of the things that perhaps in people's minds says, hey, I don't need to get a line of credit. I can use my credit card. I have a platinum card, or I have a golden card. I got an unlimited balance. Yeah, you do. But if you need $30,000 to buy inventory, the interest you're going to pay in $30,000 is compared to the interest that you're going to pay on a line of credit is it's a huge difference. Credit cards are very, very expensive when it comes into cash. Remember, you're not just buying clothes or anything like that. You're taking cash to use on an inventory that perhaps that wholesaler doesn't take credit cards. You have to go with a check. You have to go with liquid cash to buy, because that's what the offer they have. I mean, they probably need the money. That's why they have everything in offer. The same thing goes with payroll. If you have to use the money for your payroll, you're going to pay with a credit card, right? You need to put the money in the bank so the payroll company will deduct it from your bank. So those are cash advances, what I mean. And a cash advance on the credit card is always the interest rate is higher than the interest rate that the business credit line is being offered to you. Um, Now, let's talk about the different types of lines of credit. Like I said before, lines of credit, it's a big name in this business, and they have different kinds, different types, I would say. Okay, we have, for instance, the business lines of credit, the revolving line of credit, the secure line of credit, the unsecured line of credit, and we're going to analyze each one of them. Okay, yes, all of them are lines of credit. In some banks, will do all of them, or they will specialize on some of them. Let's say that you find a lender, or we find a lender for you, because obviously our job in this case, when you let us know that you're in the need of financing, our job is to find the best lender with the best terms, and the best interest rate, and the one that is going to give you exactly what you're looking for. So again, let's go back to the example of $100,000. You request at $100,000. You explain to me what kind of business you are. And I will ask you some information and some paperwork. Very small numbers of documents that needs to be presented. But I submitted to 2 or 3 lenders, not submitted just with one. Based on your industry, I have, we work with more than 70 lenders. So within those 70 lenders, there's a few in each category of industry. But our job is to submit it to different types, maybe 4 or 5. And when they come back, when the offers come back, we choose the one that is the closest to your request. For instance, I can have a lender saying, well, yeah, he needs 100, but the best I can do is 75,000, in 2 years, whatever it is, and I'll give you a line of credit. Okay, but you need 100. I'm going to start looking for someone that can give me an approval for 100. And if I cannot get the full amount, I will take the one that is giving you the most out of the 100. And that will be the best case scenario, not only for the loan amount, but also for the terms on this line of credit. So going back to the business line of credit, or the types of business line of credit, like I said, not every bank have all of the types, and some of them specialize in some, and some of them they have all of them as their portfolio loans. Now, how do we determine which loan to give you is going to be determined by the type of business that you have. And obviously, after having a 5-minute conversation with clients, and that's what we normally do. When clients call us, we're trying to understand the reason why they need funding. We ask a few questions about the business. Obviously, the business has to be established. New business needs at least 1 year in business. They have to have a checking account. They have to be deposits in that business on a monthly basis to show that the business has liquidity, that the business has income, that the business is running a healthy operation. And after I talk to the business owner and I ask him, it's a conversation, you want me to do the best job that I can for you, you need to give me some ammunition. The ammunition that can be used when I talk to any underwriter that takes, my case in all of the banks that I will be submitting all these loans. I would explain, okay, Mr. or Mrs. Underwriter, this business is in the business of, making shoes, but they make shoes for the government. They have contracts. The government is paying them in 60 or 90 days. So they have a gap in between, their cash flow is tight. They need to make the payroll, whatever the case may be. Any business have their reasons. I early on in this podcast, I said something about 4 or 5 reasons: payroll, inventory, bills, but it can be many reasons: tax payments, anything. You need to buy vehicles or whatever the case may be. There's many reasons. That's why I'm trying to understand what is your reason, what is your business reasons to request funding. Put together kind of a summary of the requirements. What and I want to know from the owner. Okay, this is what I've been doing in the last 3 or 4 months. Things are, I am in the off season, and obviously I need to continue having this business open. I cannot close even though I'm in an off season, but I'm trying to generate income, and I have bills, whatever, right? I need to know that, because if I don't have the clear picture of the business and the reason why the business needs funding, it's no way for me to transmit that to the decision making in any of the banks that I send it to. And it's very simple. 9 out of 10, or I would say 9.5 out of 10, when they hear from me about the reason that I have done my homework in asking you, why do you need funding? Asking you, how do you manage your business? What do you do? What is your season? What are your clients? What kind of product do you sell? So I can have a picture. So when I transmit that to any underwriter, the underwriter feels more comfortable, believe it or not. They work for the bank that's going to lend you the money. The bank wants to know, the first thing that any bank wants to know is people going to pay me back? Am I going to get paid back? So the bank has the right to think, okay, in order for me to believe that you're going to pay me back, tell me a little bit about yourself. By me asking the question first and presenting this case, it gives you more credibility. Number one, it tells that I did my homework, that I kind of pre-qualify you based on your business and your assets and your bank statements. You went through the first sequence of checkups, right? And by the time I get to them, it's because I think that you have a good chance of getting approved. So they make their job easier, because the first line of inquiries through me, it's done. If I said, okay, I think that this business has the qualifications for this line of credit, they can perhaps maybe ask you a little bit more questions. Maybe they call you, they want to verify some of the items and some of the points in my story. But the first step was done. And by the nowadays, knowing the way we work in some banks, they appreciate that we do this. Not every broker will go to the extreme of asking the people all these questions. Most people says, fill out this application and let me submit it, and then see what happens. They're trying to minimize the time, and I don't think that you're doing, anybody that's doing that is not fulfilling their obligation as a broker. Because my point of view, folks, is very simple. If I do my job correctly, if I present story and I back it up with not only information, but in this case would be bank statements. If I do all that and you get approved, what's going to happen next? Two things can happen. You get approved, you're happy, you happy with my service. So the minute that you need more money, you're going to come back to me and it says, look, Art, I did a loan with you last year, and everything went back. Everything was, like you said, and I was happy, and I repaid it. Now I need to get another loan. Now you feel comfortable. Now we're creating this relationship that will last as long as you want it to last, obviously. Number two is, okay, now you are in the business world. You have friends that are also in business, and a lot of people in your community that are in business. You're going to refer my business to them because your experience with us was a good experience. I was able to, or we were able as a team to provide you what you and fulfill your financial needs. So if you have something good to say, you will probably tell other people so they can benefit as well from their lending needs. I'm sorry. So that's why we do what we do. That's why we take our time in trying to determine the reason that you are asking. And I wanted to know also, okay, you said that your business is doing good. Okay, tell me about your bank statements. One thing important for the lender in this case is to see not just my story written on an email, but see really how much money is coming in. Is the business solid? Is the business making money? Now, bank statements will tell a couple of stories when you see a bank statement. You analyze the bank statement. It can see, first of all, the stories of the deposits made in any particular month, the total amount of deposits, no transfer between accounts. Okay, some people are very creative when it comes into deposits, and they have several other accounts, and so they move money on a daily basis. And yes, they're deposits, but they're not business deposits. They're just transfer between their accounts. And the underwriting, and they will inquire then back to you, what is this account? And obviously you're going to tell them this is my account. So you're moving money from savings to the business, from the business to the savings, from the savings to your business. You do that 3, 4, 5 times, and you get thousands of dollars being deposited, but it's not genuine business income. It's just you, perhaps by doing in and outs, create that amount of deposits. They will find out. They know that. That's the way some people try to show the deposits, but they're not true deposits. So again, going back to the bank statements, one section is the deposits. So they will see, if it's a wire transfer from a client out of state, they will see deposits made through maybe credit cards that people use when they buy your product, whatever, right? They see the deposits. The other section in the bank statement are all of the checks, and it's a list of checks that you wrote on your business, paying for this, that, and the other, utilities, employment, salaries, equipment, materials, whatever. And the other section are all of the credit cards or the electronic debits being done by the business. Maybe you have payments done electronically, they get out of your checking account every month automatically, or you send an ACH to another vendor to pay for equipment or materials, or your payroll is done through ACH. So those are electronic debits. So when you analyze the bank statement, so you have 3 sections, right? Now, how the underwriter sees that your business is liquid, that your business is doing fairly good? Well, they only take a look at one section, and the one section, and only the one section, are deposits. They can look at other things, but the first thing that goes into their mind is, let's see what the amount of money coming, generally, obviously, coming in every month. The minimum that any bank will take is, I would say, some banks fluctuate. Some banks will not do it for less than $40,000 a month. Some banks are doing it $30,000 a month. I got banks that go all the way to $25,000. Some banks will do $15,000. But again, let's take $20,000 as a minimum. If your business is doing $20,000 in deposits every month, then we just went through the first line of inquiries from the bank. We're okay. $20,000 genuine income on the business. Now, one thing that they look also, and they have a quick, overview of the bank statement. Was there any insufficient funds? Any checks that were issued and they have no funds in the bank, they came back for insufficient funds? We need to be careful about that. In your business, you need to be extra careful about insufficient funds, because that would play a negative, it will be a negative asset. It will be a liability to the business. It will show the underwriter that there's problem somewhere, and they dig more. They wanted to, again, we have to remember that the only thing they want is to make sure that you can pay it back. So if they see that you have written checks, and for some reason, when the check came in, that day your account was waiting for the deposit, and that day the account didn't have enough funds, and the bank didn't pay it, that's a red flag. Another red flag that we need to avoid is negative balances. At the end of the month, or at the end of every day transaction, you cannot have in any bank account a negative balance. If you have $100 today and all of a sudden a check for 150 clears the bank because the bank maybe they would pay it. It was not a big number, so they would take a risk. So they know they've been working with you for many years, so they would perhaps pay 150 even though you got 100. But what happened at the end of the day? That day you have a minus 50 as the ending balance in your account. So they don't make it a priority, obviously, because their priority is find out how much of the deposit, but they're going to look at negative balances, they're going to look at insufficient funds. And if it's a history of both of those, the risk of not getting a loan, it gets maximized, even though that you got deposits. It's not that now the business is doing well, but there is parts of the time in this month there is a problem within the business, even though they got the deposits to justify it. But it seems like you're spending more than when it comes in if you got negative amounts in at the end of the month or at the end of the day. Or it seems like you got problems also because if the check came back unpaid, it's just because you have enough funds in the bank. There's another issue. Why is that? They're going to ask you. They're going to come back to you and ask you why in this day you wrote a check and you don't have enough money. So I'm giving you this heads up because we got experience on dealing with banks and we know what makes them happy and what makes them nervous. And makes them happy means good deposit, no risk as far as canceled checks or negative balances, strong, not too strong, but a reasonable business that is making good money. Now you have an emergency, you need for funding, they were willing to help. Now, another type of line of credit, we went through the business line of credit, which is, we talk about being revolving as well. We said it at the beginning. What is revolving means is the same thing your credit card is, revolving. The credit card will give you a limit. The good thing about the credit card, it lasts forever. As long as you make the payment, you can have a credit card for years and years and years. But obviously, they charge you 29% interest rate on the money that you take out, either in the purchase or cash. The cash that you take out is limited. You cannot take all the cash you want. You have a set limit on the cash. But let's explain about the revolving. Exactly like the credit card works, the line of credit works. You use the money, you pay it back, you can reuse it again and again and again. In this type of lines of credit, they give you a term, maybe 1 year, 2 years, 3 years, depending on each institution. But also when you're done, when the 3 years is up and you need to make sure that under the 3 or the 2 or the 1 or whatever it is, you have to pay back. You can reapply. You call me and we got a good report with the lender that you had and we can generate a new line of credit, perhaps with a bigger balance, because now they know that you did good, you make the payments, you utilize the money wise, and that's what they want to hear. Now, talking about secured and unsecured. Lines of credit doesn't require collateral. You don't have to put your house or any assets or your personally guaranteed a payment. That's the unsecured line of credit. Now, there's time that depends on the amount of the line of credit, and there are banks that they go perhaps $300,000, $400,000, $500,000, depending on the business. When we go into largest amount of money, the unsecured becomes secure, and they need some sort of collateral. We work with a lot of construction companies. Sometimes they request a line of credit for $400,000, $500,000. So we ask, okay, what do you have? The last thing that I want any owner is to say, okay, I got my house. No, let's see if the business has anything of value that we can use as collateral. Normally, we use equipment, vehicles. The place of business actually can be an office, it can be a warehouse. That without putting your home in the middle of the line, for this transaction, you can use other type of assets that it will help you get the amount that you want if it's a larger amount, but also lower the interest rates when the banks give you an offer. Why? And everything comes back to a four-letter word: risk. In any transaction, the the parties that has a lot of risk are the banks. Now, if there's no collateral, which on the lower lines of credit up to, I believe, up to 200, I believe 250,000, sometimes 150,000, whatever. They said, okay, it's unsecured, like a credit card, unsecured. You don't need to sign. You need to mortgage your house. You don't need to put any equipment. You don't need to mortgage anything. You don't need to put anything on the line. Unsecured. Now, when you have an unsecured loan, any institution, the level of risk about this loan not being paid is higher, and they know that. And the reason that they know that they have a potential amount of risk that, for whatever reason, they will not get paid. So how do they minimize that risk? Is by applying a little bit of higher interest rates. They will not take the risk away, but it can help them if they, for some reason, they get defaulted on that loan. After 10 or 15 payments, they capture some of the money back, and therefore they minimize that risk. Now, when they have secure lines of credit, it's the time that the borrower puts something on the table. Okay, Mr. Borrower, what do you have that we can say, I give you a better rate and I give you a better term and I give you all the money that you need? What do you have to put on the table? Companies can put company vehicles, company property, company assets. You can actually, if you want, you can put your house, but that's your personal stuff. We're talking about business. These are business financing. So if the business have any assets, then okay, the business is doing good. We have some assets, we got some vehicles, some trucks, some machinery, whatever the case may be, and we have a warehouse, whatever, right? You put that on the table and say, okay, I guarantee that with this asset that I'm going to make the payment. So obviously now the line of credit is larger. If you have a larger amount of purchases that you need to do, a larger amount of debt that you need to pay, whatever the case is, again, and that line of credit becomes secure line of credit. So if it gets defaulted, then it's to go after the assets that were placed as a collateral for this loan. So here you have it. I mean, again, it all depends. Lines of credit they're available. Let's take one step at a time. But there's different kinds depending on the type of business that you have, the type of loans that you need, the type of strong financial scenario that you can show to the financial institution. We can put together a package, and our job is to obviously try to find the best possible option. Today, what I'm trying to explain to you folks is, and especially in lines of credit, and we're going to talk about other things like leasing or buying equipment and stuff like that. That's in another episode. But today is lines of credit, and it's not just a simple word. And there is a misconception sometimes of the lines of credit. Yes, there is lines of credit that are unsecured. Not all the lines of credit are unsecured. It depends on how much money you request. Yes, there is risk to the bank, and the banks put that risk in the form of interest rates. And we all need to know that this is not going to the bank and applying for a mortgage on your house on a 30-year loan or 15-year loan, because those 15-year loans or 30-year loans, they're at the best rate possible in the market, which, by the way, today's prime rate is 8.5%. So those loans, or it goes going down. I mean, the market is fluctuating, but those loans are based on a property that you're purchasing or refinancing. It's your house. So the bank has a big collateral there, which is the home. And normally that home perhaps is appraised for more than what they're lending you. So if you've decided that you cannot afford that payment anymore, the bank will repossess the house. They will get their money. So these are not the type of loans. These are business loans that they're being focused on a business financial issue, which is I need money right away. If I don't want to put any collateral, we need to go for a lower limit. And if I have a larger amount of money that I need to ask, and then I need to perhaps use some of the collateral and put something on the table so the bank will feel more strong about my case. That is basically, in the nutshell, those are the type of lines of credit. Now, people say, well, what do I do? What is the application process? I believe that in this conversation, I took your guys and I explained some of the things that we do when we take an application. It's a good question. In order to realize what we're standing in front of the client, what can we do to help this client achieve their financial goals, we need to understand the type of borrowing that this client is trying to accomplish. What type of credit, if it's a line of credit, or perhaps they just need money to buy inventory, or whatever the case is. Step one is understanding the financial needs of the business owner. It's not just about writing a name and then social security number and business and how much money you need and give me the bank statement. No. Some people do that. And the difference between day and night is the people that do that so quickly, and they tell you, just give me some information and I give you, I give you an approval in 24 hours. Statistics show that kind of behavior in us as a broker, they don't get things done. You really have to be very strong. They might get something done. But without understanding what is going on, you leave out the door open for any underwriter of any bank to ask whatever they want. And perhaps if they don't understand what your business do, you have the risk of getting a no as an answer. Versus us doing the questioning, us understanding your needs, us putting together a picture to this underwriter, to this bank, this institution about you and your business, and trying to explain and make them feel comfortable about your business so they can lend the money that you're looking for and the time that you're looking for, which is now. Yes, sometimes we get no's. I'm not saying that I don't get all yes. No, I will not be saying the real truth about this business. We get no's as well. We try. I see bank statements that have some flaws, and I even tell the business owner, listen, I would submit it. I will explain as much as I can, but I see these potential problems. And I want you to be aware of if I come back with a no, it's because, not because we don't want your business, it's just because sometimes you're not showing what they want to see, right? So what do I do? Basically, I kind of know that it might be a possibility of disapproval. I see a lot of canceled checks, non-sufficient funds. I see some negative balances. I see that the level of income really fluctuates very deep into high and lows. One month is 3,000, the other month is 40,000, and it's really difficult to run a business like that because you don't have kind of a. We understand there's oscillations between income. Okay, we understand about and any bank will understand that businesses are seasonal as well. I mean, you can if you're a tax return preparer, for instance, everybody in this country knows that when you prepare taxes for other people, that your best months are January, February, March, April. What happened after April, go all the way to January, is obviously not tax season. So these people, they get income on those 5 months that will probably last them for the whole year, which is true. But we need to explain that. Because if I show the bank out of 6 month bank statement, 3 with incredibly high amounts of deposit, and the last 3 is if we are in September, for instance, or October, the income really shuts down dramatically. There has to be an explanation when they have high season, and now we compare. Now we all know, the underwriting knows, and everything else. So, but if I see a business that is steady through the whole year, and they have months that are very, very poor, there has to be an explanation. And that's what my job is, to ask. What happened? Look, I'm looking at the 6 months bank statement. What happened in April, for instance? Why your income or your deposits, in this case, went from an average of $40,000 to $2,000? What happened that month? I have to ask because I know that you're going to be asked that, or they're going to ask me. The bank is going to ask the same questions. It's better than me. I tell them up front than for you to wait for somebody to give you a question. You give them an answer, and for some reason they don't get it. Loan is declined. If I said it, I put him in a form of an explanation before they see it, and they appreciate that because they don't have to do any digging. They don't have to think, oh, what's going to happen? Let me call. Let me waste my time. Let me call the owner. Let me see what kind of explanation do they have. No. We are trying to eliminate miscommunication, if you will, and we're trying to put together this picture of the business the best way possible. That's what we do, and that's our job. So, obviously, in the application process, it's good to know, for us to know the business, and for the business owner to tell us why do they need the money. Yes, there is a kind of an application at the beginning. Yes, I have to get information. I mean, we need to know the name of the business, your name, your social security number. We need to know that at least, you don't need to have 800 score on your credit report. But you need to have some sort of a decent score. You need to at least pay your bills somewhat in time. Some banks will not go below 550. But in order to get 550, really, with 550, you already have problems. Otherwise, you will not get 550. But banks that were very nervous about taking, below 550, sometimes it's 560, 570. Some of them are 620. It all depends. It all depends on the bank. It depends on the loan. Depends on the amount. But you need to have to show that you're at least trying to make an effort to make the payment. There are going to be some lates here and some lates there. Fine, as long as you're making the payment. They don't want to see, for instance, they don't want to see foreclosures. They don't want to see bankruptcies happen in the last year. They don't want to see repossessions, because obviously those are heavy duty things that happen in people's life. The bank doesn't want to see them that happen in the last 6 months. That would be one of the reasons that would say that no, it's too much risk for me, and they will not give you an offer or give you an approval. But overall, if you got some decent credit, it's fine. There's not too many documents, like I said. They're going to ask you for bank statements. The higher that we go on the amount, maybe the more they're going to perhaps ask you. If you're going from $500 to $1 million on a loan, they're definitely going to ask you for tax returns. They're going to see if you really file tax returns, how much money you made at the end of the year, not just the deposit. The deposit is the cash coming in. The deposit is the money that they know that you have, that they can actually grab every month and get paid. Because obviously you're not making a check to any bank. The bank will automatically go to your business account and take the payment out. So they're going to make sure that you have this cash flow coming in. That's the most important thing. But also, if you applying for a large amount of money in the form of any loan, they might be asking you for tax return, either personal or business. They want to see really what your final income was for the year. Okay. Yes, they're going to do a credit check, like I said before. The credit check, it's important, but it's not the most important item, because they'll know that there's certain months that you run into certain problems, and maybe there was a late payment on your car or a late payment in a bit and on a credit card. But overall, all of the other payments are fine. Your mortgage is fine, so your obligations are fine. A little bit of late, it's not going to make a big dent on your score as well. But yes, they're going to do a credit check. They want to know exactly what the business owner has as a business owner. If they're going to do also, if the business, one thing that is super important, I forgot to talk about credit. If the business have credit, that is super important. If you're a business owner and you happen to get the opportunity to give your business a credit card under your business name, not your personal, your business name, and you get credit cards and loans, financing through, maybe you get your warehouse and purchase the warehouse under the business name, so the business is the one responsible to make the payments. Everything is good. It's good because now the bank knows that not only you as a person have credit, the business has credit as well, and that is a big plus. I encourage business owners to apply for credit under their business. It's very important before you apply for a line of credit, obviously. Excuse me. And that is super important because now they see your business as an entity that is capable of getting other loans, not just this line of credit. So yeah, they're looking at the business that they're standing on their own with their credit, and they're growing. I super encourage business owners to do that. It's not an easy task, but it's not an impossible task as well. If you start creating a small inquiries on I can see happen, a gas car. If you use trucks and you use cars on the business, and maybe you can get a credit card just for the gas in the business names. That will show in a business credit report, not your credit report, in the business credit report. Obviously, the business have to qualify, not you as a person. Otherwise, if you qualify, it goes into your personal credit. This is a business credit, which gets reported in a much different way than the personal credit. It's different entities report personal, and another entity reports business. Banks look at to see if you got a rating, if the business have a credit rating, which is super important. If you do that and the credit rating is great, then that's it. Even if the deposits are a little unbalanced per se, but the business have credit. The business have reputation of paying the bills on time, and that's the biggest risk that the bank has. Is it going to pay me back? You're just showing the bank that we're paying the gas, the car loans, or the mortgage on a business property on time. Why we not pay the line of credit on time? It's a big plus. So keep that in mind, folks. As far as growing your business and choosing the right loan, you want to show that your business is actually healthy as far as financial is concerned. Now, when you get a loan, when you get a line of credit, you need to consider a few things. And obviously, that's part of what we do for your folks when we look for the best lenders in this case. Interest rates, repayment terms, fees, credit limit, flexibility, if they need collateral, and how fast they get approved. I'm going to go very fast on these things because that's part of what we do for you. Look at the areas that we touch when we submit a loan. First of all, the biggest concern about everyone is what's the interest rate? How much am I going to be paying on this loan? We're trying to get the best rates on when we find on approval. What are the terms? What are the repayment terms? I mean, is it for 1 year, 2 years, 4 years? It all depends. What is it that you want? Maybe you want a loan for 6 months, and you know that you can pay in 6 months, get it over with, less interest rate because you had an emergency. So that's why it's important the conversation at the beginning. I want to know what really is happening to you financially and what are your needs. So the repayment terms is important, and the banks obviously if they do it in the short term is for them is better because they get more money being paid quickly and they know the risk is minimized than if you get 2 years, right? But you will choose what are the repayment terms, and you tell me I want something that it will last me at least 2 years, so I'm going to be looking for the 2-year repayment terms. Or you tell me I need just 6 months, so I'll be looking for a better condition on your credit, better benefit to you if I get a better rate because your term is short. And obviously the fees associated with getting a loan. Obviously there's bank fees that they get charged to the borrower. Their underwriting, their processing, their document preparation, whatever they need to do and whatever they do internally to get these funds to you. And we will, and they will call you once they get loan approved. They want to also know that you are real, okay, that you are a person. So either they do it through us or directly they do it to them if they have any questions, but you will get in contact with one of the bank's representative and they will verify some information, but they will tell you exactly, that we are also in the loop, and they will tell you exactly, what the terms are, and if you got any more questions just before funding. They will tell you if this line of credit has any stipulations. I mean, this line of credit don't really allow to renew it more than once, or they can renew it unlimited. Most of the time, most banks, if you pay the first one, they give you a second one and a third one. But some banks are different, obviously. And one of the things also they asking is about the collateral. Like we talked about the collateral earlier. I mean, if you're looking for a larger loan, they might ask you, okay, what do you have to put in the table? And one thing that you will not tell them that you're going to put on the table is your home, because it's a business loan. You don't want that in have your home as a tool of proving that you're going to pay. This is not a residential loan. This is a business loan. They're looking for something else besides your home. They might ask if it's for millions of dollars. They might say, okay, well, you got any assets, any lots, any other investment properties, because we're looking at millions of dollars. But for $150,000, no, you don't have to put your home as a collateral. And then when it comes into approval and agreement and access of funds, that goes in together in the same pot. The approval normally takes, I would say, 24, 48 hours, depending on if there's any complexity on the loan. There is something they don't have clear from me or clear from you. I don't get it clear from you. Obviously, they don't get it clear from me. They might make a call either to me to find out or to you directly. Listen, what happened this month on your bank statements. I don't know why your income or your deposits dropped tremendously. Whatever it is that would maybe delay the approval, the access to funds after, obviously we close. There is, contracts to be signed, documents to be signed, blah, blah, blah. And then they take another, I would say, day or two to, wire the money to your account and it's done deal. So everything together from day one to the money hitting your bank account, I would say perhaps a week or maybe less than a week. Times changes according to the case, according to the borrower, according to the bank that is actually wants to fund this loan, and according to the terms. Sometimes they give you an offer and you say, well, look, I like the loan amount, I like the rate, but I don't like the terms. I like to extend it, I like to reduce it, so we need to go back to underwriting. You got an approval, but you're trying to make it better for you, which is, I'm more than happy to do it. That's what we do. You said to me, listen, they give me 150,000, they give me the interest rate that I want, but they give me 2 years. I want 3 years. Can we get 3 years? Obviously, I'm going to fight and try to get 3 years. If they say yes, okay, we'll do 3 years, fine. It may say no, this 2 years is the max we can do, then it's the max they can do. Either we start all over again with another bank, or we take the 2 years. So things like that, this requires time. Communication is time. Answers are time. Decisions are time. That's why I don't want to make it and give you a number of days, because it will not be precise. It can fluctuate. Okay. Now, we talk about lines of credit and then we'll run out of time. I just wanted to remind you that Business Lending Brokers is a company that is actually working with small and medium-sized business owners. This podcast is being done every Monday from 2 to 3. We are always live in Facebook, LinkedIn, YouTube. You can visit our website at www.businesslendingbrokers.com. If you wanted to communicate with us, you can send us an email. My personal email is Arturo, Arturo, at businesslendingbrokers.com. Our phone number, we're here in the city of Tampa in Florida. Our phone number is area code 813-767-1814. For anyone that wants to perhaps have questions or perhaps, needs funding, or this is what we're here for. Thank you for tuning in. Also, but don't want to forget Spotify, Google Podcasts, iTunes. We are in every major platform there is when it talks about podcasts. We also have webinars. We don't have dates for those webinars, but they obviously we have done a few. We're going to make more. We will post when the next webinar is going to be, so you get registered, and it's a very live and very active webinar where all your folks can join. It's a free webinar. And you guys can join us and ask questions, and we can have discussions about business lending. So subscribe to